Most beginner investors don't lose money because they are unlucky. They lose money because of simple mistakes that could have been avoided. Every year, thousands of new investors in America lose huge amounts of money by making emotional decisions, following hype, and investing without a proper plan. In this video, we'll discuss the biggest investing mistakes beginners make and how you can avoid them. Number 1 mistake: trying to time the market. Many beginners believe they can predict exactly when the stock market will go up or down. They wait for the perfect moment to invest, hoping to buy at the lowest price and sell at the highest. But the reality is very different. Even professional investors struggle to predict short-term market movements consistently. Research shows that missing only a few of the stock market's best days can dramatically reduce long-term returns. The problem is that the market's biggest recovery days often happen unexpectedly, right after major declines. Investors who stay out of the market waiting for the perfect time usually miss these powerful rebounds. Instead of trying to predict the market, successful investors focus on consistency. They invest regularly and think long-term. Time in the market is usually more important than timing the market. Second major mistake: panic selling during market crashes. When the market falls sharply, many beginners become emotional and sell their investments out of fear. Watching portfolio values decline can feel stressful, especially for new investors. But panic selling is one of the fastest ways to lock in losses. Historically, the U.S. stock market has recovered from crashes, recessions, and economic crises many times. Investors who stay patient during difficult periods often benefit when markets recover. But emotional investors sell at the worst possible time and miss the rebound later. Successful investing requires emotional discipline. Market volatility is normal. Temporary declines are part of long-term investing. Third mistake: lack of diversification. Many beginners put most of their money into a single stock or one popular sector. If that company performs badly, their entire portfolio suffers. This creates unnecessary risk. Diversification means spreading investments across different companies, industries, and asset types. The purpose is simple: reducing risk. If one investment performs poorly, other investments may help balance the losses. This is one reason why many long-term investors prefer diversified index funds. They provide exposure to hundreds of companies instead of relying on one single stock. Fourth mistake: chasing hot stocks and social media hype. Today, social media platforms are full of people promoting the next big stock. Beginners often buy investments simply because they see others talking about them online. But hype is not research. By the time a stock becomes extremely popular online, professional investors may already be taking profits. Many beginners buy near the top and suffer heavy losses when excitement disappears. Smart investors do their own research. They focus on company fundamentals, long-term growth potential, and financial stability instead of emotional hype. Fifth mistake: ignoring fees and costs. Many beginners underestimate how much fees can impact long-term returns. High management fees, trading commissions, and expensive investment products slowly reduce portfolio growth over time. At first, these fees may seem small, but over decades, they can cost investors thousands of dollars because of compounding. This is why many experienced investors prefer low-cost index funds and ETFs. Reducing unnecessary fees allows more money to remain invested and continue growing over the long term. Sixth mistake: investing without clear goals. Some beginners start investing because everyone else is doing it, but they don't actually know why they are investing. Are you investing for retirement, financial freedom, buying a home, building long-term wealth? Every financial goal requires a different strategy, time horizon, and level of risk. Without a clear plan, investors often make emotional decisions and constantly change strategies whenever the market becomes volatile. A strong investment plan helps investors stay disciplined during uncertain times. Seventh mistake: not having an emergency fund. Some beginners invest all of their savings into the stock market without keeping cash for emergencies. Then when unexpected expenses appear, medical bills, job loss, or repairs, they are forced to sell investments at a bad time. An emergency fund creates financial security. It prevents investors from making emotional decisions during difficult situations. Many financial experts recommend keeping several months of living expenses in an emergency fund before heavily investing in the market. So how can beginners avoid these costly investing mistakes? First, invest consistently instead of trying to predict the market. Second, think long-term and allow compounding to work over time. Third, diversify investments to reduce unnecessary risk. Fourth, avoid emotional decisions and ignore social media hype. And finally, focus on discipline, patience, and continuous learning. Successful investing is usually not about getting rich quickly. It's about building wealth slowly and consistently over many years. The biggest investing advantage is not intelligence, it's discipline. Investors who stay patient, avoid emotional mistakes, and follow a long-term strategy often achieve better results than those constantly chasing quick profits.